Welcome back, everyone. Sean Stevens here again with Metroplex Mortgage Services in another USDA Loan Pro video quick tip. USDA rural home loans are sought after by homebuyers for their flexibility, and one well-known feature is the ability to finance out-of-pocket closing costs. However, additional guidelines do apply, and today's video tip will cover what you need to know to see how you can finance closing costs into a USDA loan. But before we get started, for those who have been denied by another lender or bank, please take advantage of our free second opinion service. This resource is designed to help realtors and buyers alike get access to an expert second opinion, which is great for both pre-qualifications and those loans that are currently in progress. So without further delay, let's get started with the details. How can you finance closing costs with a USDA loan? As a starting point, USDA loans allow for no down payment, otherwise known as 100% financing, but that should not be confused with no money out of pocket. Customarily, a buyer will have two types of out-of-pocket expenses: down payment and settlement charges, also known as closing cost. USDA loans eliminate the need for a down payment, but the home buyer is still responsible for their respective costs. This can either be paid by using their own funds, negotiated for the seller to pay through the sales contract, or, in the case of a USDA home loan, the possible ability to finance those costs into the loan. Financing closing costs with a USDA loan is available in cases when the appraised value is higher than the agreed upon sales price. Here are examples of what settlement charges can be financed into a USDA loan. Closing costs such as title charges, loan cost, survey, recording fees, etc. Prepaid items such as your escrow accounts, homeowner's insurance premium, and prepaid interest. Key points to remember are that the appraised value must be higher than the sales price for this feature to be available. This is unique for USDA home loans and not available under conventional FHA or VA programs. Homebuyers should be cautious if they are solely relying on financing closing costs to cover their out-of-pocket expenses, because that is determined by the final appraised value, which happens after the sales contract is agreed upon. Financing closing costs should be viewed as a potential advantage, not a guarantee. Now remember, we are unique because as a USDA approved lender, we have dedicated systems in place for USDA processing from pre-qualification through closing. Just call or email to discuss your scenario and let us show you the Metroplex difference. I want everyone to make it a great day and look forward to seeing you right here for the next tip of the week.